Stocks are crashing, and it might be for the stupidest reason ever. From the very start of September, all the markets have done is basically go down in a straight line. The NASDAQ in the first few trading days of September is down 3.5%, and this really isn't coincidence. If we look at this chart here, this shows us that September is historically the worst month on record for stock market returns. In fact, there have been more down months or red months than there have been up months or green months, which is crazy to think about. And the average return in the month of September since 1928 is negative 1.17%. Painful, painful, painful. And yeah, this literally is causing people to sell out of their stocks, which I made my opinion very clear on X the other day. I said selling because it's September might be the stupidest thing ever. If you were asked to participate in an attractive private business opportunity today, would you immediately shoot it down and say, sorry, I can't do it because it's September? Heck no. No, you wouldn't. You wouldn't do that. So why would you do that in the public markets? It makes no sense. And further, the bears are going to spew this all around like they like to do. But if you dig a little bit deeper into the data, two major random catalysts happened in the month of September in our history. First, it was the 9/11 attacks, which obviously happened in September. Very unfortunate event, and it led the stock market to crash quite significantly. You'd be silly to say that that is a seasonal thing that just tends to happen every September. Further, have you heard of the Lehman Brothers? Yeah, when that collapsed, that was the start of the great financial crisis in 2008, 2009, and maybe even to 2010. The Lehman Brothers collapse happened in the month of September. You'd be very silly to say that that is a seasonal thing that just happens every September. The reason I'm bringing these two events up is because if you strip those two totally random events out of September's average performance since 1928, September actually is just another green month. And again, it's a stupid argument to make that those two major bearish catalysts are seasonal things that are going to impact the markets every single year. And that sways the data on the month of September tremendously, from looking like a very poor month of returns to actually looking like a very good month, a positive month of returns on average since 1928. So there you go. There's the data that nobody else will tell you that I share with you on this YouTube channel. I try and remain unbiased. And if you appreciate that and the research I do, it'd mean a lot to me if you hit the like button down below. And while you're down there, hit the subscribe button. It's just really close. And we have one of the fastest growing stock market YouTube channels on this platform. And I'd love to continue that. And if you like the analysis I do, I am entirely self-funded and independent. So your monthly support means a lot to me if you choose to join my membership via the Patreon link in the pinned comment or the join button located right next to the subscribe button. But other than that, just the fact you're choosing to watch this video means a lot to me. So thank you, thank you, thank you. But yeah, if you want to go the extra mile, get access to a bunch of great perks, check out that membership. But anyways, let's continue on with this video. There's not really that much else to say about this whole sell in September thing than what I just gave you. So let's move on to the yield curve disinversion, which I predicted several weeks ago that this would be the bears' next talking point. They'd come back to the yield curve and say, oh, the yield curve is finally disinverting, so now we're going to have this recession that we've been calling for 24 plus months. And I say, baloney. This is a picture of the yield curve. And yes, today it finally did disinvert. It's practically flat, but factually it disinverted. What a lot of people get confused on when it comes to the yield curve is they think that it predicts recessions, or even that it causes recessions. They think that it's a representation of economic conditions in our country, and it really isn't. What it is a reflection of market expectations at any given point in time. That's what the yield curve is. And the fact that the yield curve was inverted just simply is a reflection of the fact that people thought the federal funds rate would be cut very, very swiftly. Like, for example, as the Federal Reserve has increased the federal funds rate over the past couple of years, it lifts short-term yields on Treasury notes and bills, but bond investors actually choose to lock in the longer term duration, lock in that longer term higher yield, because they think that something is going to break in the financial system that causes the Federal Reserve to cut interest rates rapidly and repeatedly for many, many months in a row. And they don't want to be caught up in that if they buy a short-term treasury. And in the past, that has been a very good strategy, because in the past, it's taken way too long for the Federal Reserve to start cutting interest rates. You see, there's kind of a credit cycle that I've laid out on this channel in the past. You have a rise in the federal funds rate or tightening of monetary policy that can eventually trigger a financial crisis. If that financial crisis is not contained, it can turn into a credit crunch where even good borrowers can't borrow money, and that credit crunch then turns into an economy-wide recession. This time around, we did get a financial crisis as a result of tightening monetary policy. We can see that on this chart here. In March of 2023, do you remember when Silicon Valley Bank failed? Because I do. That was a scare for the markets, and rightfully so. But what did the Federal Reserve do? Well, as a result of everything they've learned through history, they've become very adept at playing basically whack-a-mole with any financial crisis that pops up in our system. You can even think back to the Great Virus Crisis and how they stimulated the economy during that crisis because of what they've learned in the past as a result of prior financial crises. So last March, we did get a financial crisis, but it didn't morph into a credit crunch because the Federal Reserve introduced the Bank Term Funding Program and prevented that crisis, again, from becoming a credit crunch and thus an economy-wide recession. Most people believe in long and variable lags, that if interest rates are too high for too long, eventually it tampers down demand for goods and people quit spending their money, and eventually the bottom falls out of the economy and we see a recession. I don't believe in that thesis, and that's partly because right now is not the abnormality. You know what's the abnormality? It's 0% on the federal funds rate. And that's shown on this chart here. I think people get lost in the sauce with this too. Right now, this is more normal than the free money policy we experienced post-pandemic and after the great financial crisis of 2008 and 2009. Our economy has proven in the past, and albeit in the past, our economy was much more interest rate sensitive than it is today. And our economy performed just fine with interest rates of 5.5% or even higher than that. So why bears and just investors in general think that our economy can't sustain a federal funds rate of 5.5% is just beyond me. And I know maybe the argument is, well, this hurts the government because interest rates are higher, which means they have to pay more interest on the government's outstanding debt. And yes, that's true, but it's kind of a bass-backwards argument, because if we lower the federal funds rate, you know what happens? The government just ends up borrowing more money because it's cheaper to borrow that money, and the problem remains and even gets even worse because we're borrowing more money, making the problem worse. But back to the point I was making, the reason the yield curve has disinverted in the past is because something was broken in the financial system. We had a financial crisis and the Federal Reserve had to cut interest rates, cut them overnight, and cut them very quickly and aggressively. You can see this on the chart. Anytime that the yield curve has been in negative territory and it has snapped back into positive territory, it has come after the Federal Reserve has cut interest rates to stimulate the economy, but it was too late. It was after a financial crisis morphed into that credit crunch. This time around, we don't have that because of what the Federal Reserve has learned, as well as a bunch of other demographic things we have today that we haven't in the past. For example, baby boomers, they're retiring with a record $77 trillion of net worth, and they have an itch to spend that money. That sort of thing overall is going to lift the economy up. Even if it starts to falter, that sort of net worth, that sort of wealth, I don't care if it goes into entertainment, I don't care if it goes into food spending, I don't care if it gets passed down to the next generation, that is stimulative to the economy. And that's a demographic shift that we haven't had in the past. So bottom line, if there is no financial crisis and there is no credit crunch, and the Fed is simply cutting rates for monetary maintenance purposes, the yield curve can disinvert without a recession taking place, because this time is different. I've said it a million times, it feels like, in this video, but this time is different. Now, I'm kind of weird. I am bullish on the stock market, but I actually don't think the markets or the economy need rate cuts. You see, a lot of people's bias when you read what influencers post on X or what they talk about on YouTube, a lot of them are actually bulls that they think we need interest rate cuts for this bull market to continue. I don't believe that's the case at all. I think this bull market will rally on just as it has at the federal funds rate of 5.5%. Now, I do think the federal funds rate is going to come down. I just think the market's very similar to how they were pricing in an abundance of rate cuts going into this year, into 2024. They're doing the same thing going into 2025. And I think this is going to end up being incorrect. Right now, based on this chart from Bloomberg, it shows you the implied federal funds rate, and it tells us that investors right now are pricing in a rate cut at literally every single Federal Reserve board meeting until the end of next year. I simply don't think that's going to be the case. You know, going into 2024, there were 6, 7, 8 rate cuts priced into the markets, and we were one of the only people on the internet saying, yeah, I don't think that's going to happen. And what do you know? We're already to September, and we've yet to see our first rate cut in 2024. I think we're going to see a very similar thing unfold in 2025. You have to remember that, you know, honestly, as a bull, you don't really want interest rates to be super low, because when the federal funds rate is super low, it creates capital misallocations, which forms bubbles. And when bubbles form, you know, the fallout from that bubble popping is very painful and can take years, if not over a decade, to recover from, just based on historical data that we can look at. So unless we really need it, we want the federal funds rate to remain somewhat elevated, because that also gives the Federal Reserve the ability to make statement rate cuts if some sort of black swan event does occur in our economy, which black swans are random. They can happen at any given point in time. Well, let's say that the federal funds rate right now was at this 0% level and some black swan event popped up and the Federal Reserve had to stimulate the economy. Their only choice would be to either cut interest rates into negative territory, which is where banks would actually start paying you to lend money from them. That's a situation that we don't really want, but that is what would have to happen. There's certain other programs they could introduce, but the ability to cut rates, if something truly recessionary or black swanish pops up in our system, that ability to cut rates is such a major advantage, and it actually takes risk out of the system. And that's a very good thing if you are a bull on this stock market for years to come. You also can see it in this chart. Over the next 12 months, the markets are anticipating 8.7, basically 9 rate cuts, which, yes, works out to, at every single Federal Reserve board meeting, them cutting interest rates. I just don't think it's going to happen. And really, you know, as the federal funds rate does get cut, because it will, they'll cut rates on September 18th, I think by 25 basis points. I'll get into a chart here in a little bit that shows that. But as the federal funds rate is cut and we have a weaker dollar, it's actually going to be a wind at the back of the economy and the stock market. And I don't think either of them really need the extra push. I really don't. I don't see that in the economic data at all. Sure, the labor market is softening, but what people don't realize is we can have a labor market that's softening without it being recessionary. It can just simply be normalizing, which is what I think is taking place right now. Another set of data that bears point to is, well, Dollar General had horrible earnings report. Well, no, it didn't, because sales growth year over year was 4%. 4% sales growth. A recession, if the consumer was really struggling, there would be 0 sales growth. There would be negative sales growth. Just the fact alone that Dollar General stock fell 30 to 40% does not mean that the economy is weak and that the consumer is weak. Go a little bit deeper than that. Look at the actual data. And Dollar General, Family Tree, whatever it was, both of them are still forecasting sales growth this year of 6 to 7%. That is not a weak consumer, even though the stock price cratered 30, 40%. But here's what the markets are pricing in right now for the September 18th Federal Reserve meeting. As of today, there's a 59% chance of a 25 basis point rate cut and a 41% chance of a 50 basis point rate cut. If you're watching this video on Thursday, September 5th, it just so happens that tomorrow, I'm probably not making this video at the right time, but tomorrow is a huge employment report. that's going to come out and show a lot of August jobs data. And that alone will shift these probabilities a bunch. That alone will determine whether the Federal Reserve cuts rates by 25 or 50 basis points. I believe, I'll go on record, I could be wrong, but we've been pretty accurate when it comes to economic stuff and market reactions. I believe that the labor market report tomorrow is going to come in stronger than expected. I think job growth is going to be very good. I think the unemployment rate will fall to 4.2%. And ultimately, I think that's going to result in the Federal Reserve only cutting rates by 25 basis points. And I think the markets will start to deprice this abundance of rate cuts they've priced into the markets for over the next 12 months. I just don't think it's very realistic at this point. The other thing is, if we look at the Atlanta Fed's GDP Now tracking model, this website really isn't that sexy. I wish it was a little more glamorous, but it's not. All you need to know is the latest estimate for Q3's GDP growth is 2.1%. And nothing about that screams recession. Nothing about that screams a weak economy. Nothing about that signals we need an abundance of rate cuts to stimulate the economy. And that's just a matter of fact. And then one last note before I sign off for the day, and this is somewhat important, so don't tune out. We have a big election coming up, and most of the time, I believe, whoever's in office, it really won't matter much to stock market returns. I mean, the data kind of proves that, kind of shows that. You can make data tell you whatever you want it to. Under Republican presidents, the stock market's done really well, or under Democratic presidents, it's done really well, or whenever we've had economic crashes, that's a result of the prior administration and their policies, not the current administration. And depending on what side of the aisle you're on, your argument's going to be different. So this election, I will say, I think this is going to be much more impactful to the stock market and the bond market than most prior elections have been. And why is that? Well, it's because based on what both candidates' platforms are, they plan to continue spending on a budget deficit. And that does a few things to the economy. First of all, let's say Kamala Harris wins. She's going to go on a major spending binge. That's going to be stimulative to the economy at the expense of, again, spending on a budget deficit and the Federal Reserve having to print more money, or the government having to print more money, whatever way you want to put it. The government's printing more money, which is going to be inflationary, meaning that inflation is going to trend higher than average over the next 4 years if Kamala is elected, which means interest rates will have to be higher than average over the next 4 years in order to tamper down inflation. On the other hand, Donald Trump, he wants to cut the corporate tax rate. He wants to cut income taxes. That also is not going to solve the federal budget deficit problem. And then, it will be stimulative to the economy, but it too will result in the government having to print more money, which, is stimulative, but it also adds to inflation. So there's a few things that I think will happen in the case of a Democratic or a Republican sweep. That's when either party controls all facets of the government. As an investor, we should be voting for and we should be rooting for gridlock, because gridlock has been very successful at preventing these widespread, crazy sweeping changes that many candidates want to make. It's done its job at preventing that stuff from taking place. But a Democratic or a Republican sweep would result in a lot of Kamala Harris's policies going through and a lot of Donald Trump's policies going through. I'm not saying Kamala Harris is the enemy here. A lot of what Donald Trump did under his term was also the same thing. He did a lot of things with executive orders. Anyways, we're kind of going down a bird walk. The bottom line is the three areas that I think are going to be impacted by this election, if we have a Democratic or Republican sweep, is interest rates will be higher than average for longer. Inflation will be higher than average. And actually, growth of the economy will be higher than average. But ultimately, you can say what you want. You can, depending on what side of the aisle you're on, you're going to say the other side is destroying democracy. The other side is crashing our economy. The other side is destroying our country. I'm very much so in the middle. I'm a registered nonpartisan because both parties are a clown show, man. I don't want to vote for either one of them. But it gives me a unique perspective, Bottom line, regardless of what you hear your pundits say, regardless of what you think about politics, studies show that everything's going to be okay. We have hundreds of years of history that prove this. No matter who is in office, no matter what happens, over the long term, the stock market is going to be just fine. So quit stressing about this. Quit sweating about this. You know, politics have a very low ROI, and that's why, I think it's important to care. I think it's important to vote. But when you are drowning yourself in political content, I think it's a waste of time. I would much rather focus on how to make money, studying the markets, studying the macroeconomy, than, I won't call it a waste of time, but overemphasizing, putting too much effort and time into the political realm. Okay, so there's my 2 pieces of political information for the day. I know you probably don't really care. I'm a 23-year-old that is learning every single day. I don't know everything, okay? I want to make that clear. I don't have a crystal ball. I wish I did, but I don't, unfortunately. But yeah, with that, let me know down in the comment section below if you agree with me that this sort of market crash is really silly, or if you disagree with me, that's fine too. Let me know. I always love having that sort of discourse. I love hearing everybody's different opinions. I think it makes everybody sharper. I think it helps everybody make more money over the long term. With that, again, subscribe if you're new here, returning and not yet subscribed. Have a great rest of your day. Stay blessed. Keep 10 toes to the ground, near your chin up. Peace out.